thing, I mean, as you explained, that these new measures basically curb excessive speculation whenever there is a big global move in the currency, right? That's the end objective
Right.
of these overnight regulations, correct?
Right. Absolutely.
Okay.
Absolutely.
Now, now, what have you made of the rupee's strength over the last 2 weeks since the RBI started taking some bold measures, including the FCNRB deposit scheme? Banks have been offering pretty lucrative rates as well. So, what is the market assessment right now? How much money could come in? And has it all been priced in already?
See, the Indian rupee revival is like the monsoon revival from suddenly when everything was going wrong. The three levers have kicked in. The first lever was the RBI's FCNRB and the ECB announcement. That is going to bring in a significant amount of capital by September 30th because that's the window. Estimates anywhere between 40 to 60 billion. And that is unhedged flows, which means it will actually hit your spot market. And secondly, the collapse in the commodity prices, which we have seen over the past couple of weeks, that is going to create a disinflationary environment with Brent almost at 70 and other commodities are collapsing. That will ensure that RBI, the easing the RBI has done with the FPI investment in debt, that will start to have its impact because we are already seeing in June in equity, close to 5.7 billion is the outflow of FPIs. But in debt, it is the total inflow is $4 billion almost. So this will pick up. So that is the second lever. The first lever stabilized the rupee. That stopped the outflow from debt. The second lever is going to also bring in the flows, but that is more medium and long term. And the third, but for third, we have to wait is once the AI trade unwinds, whenever it happens, that will bring capital into the equity market. But let's keep the third lever aside. The first two are enough to push the Indian rupee towards 92 levels if the RBI allows.
And this is interesting, Anindya, because this is happening at a time when the dollar has been strengthening. Because while US yields are cooling off, the dollar is doing its own thing. Whatever it's reacting to, maybe still reacting to inflation worries, interest rate worries. But do you expect the rupee can keep strengthening even in the face of dollar
Yes,
strength?
yes, because Indian rupee was one of the few currencies in the world which had fallen so much year till date, till the appreciation started. So it was one of the worst performing currencies. And naturally, with oil at 70 now, it creates that delta, that attractiveness to own the rupee, at least not short the rupee, because it doesn't make sense for a speculator to go and short the rupee. Yes, we could continue to see outflows from equity, but that will be completely overshadowed by the inflows which I talked about. So I think yes, this divergence can continue for a couple of months. That Indian rupee can strengthen, and the dollar index can continue to inch higher based on the Fed expectation. But once that window of flow, especially through the FCNRB and the ECB is over, then again we'll see a convergence. But by then, the Fed may pivot because the whole hawkishness of Fed. The question is how long they can sustain it.
Yeah, yeah, absolutely. And I mean, if the war is over, if oil is really going to be so well behaved, and if it stays around 70, then maybe the Fed doesn't have too much reason to be too hawkish. We'll see. Anindya, quickly before we let you go, since you track all the cross markets, including gold, leave us with a view. I mean, what's going on there? Gold, just the fall is non-stop, right? And as I'm looking at the global prices right now, we should fire up international gold. It's slipped below 4,000 as well.
Yes, so the Fed interest rate cycle is playing out because the US yields, if you look at the short-term yields, they are at a 15-month high. The US two-year yields, that's pricing in 2 to 3 hikes over the next 12 months, which looks a little too much according to us. But right now, that's what the market is playing. That's the reason why gold, silver, in fact, the entire commodity complex is getting butchered. But in the short term, it can fall towards 3,700, 3,600. But these are great levels where the long term investor should come in. The silver could fall towards $50 or $48. But these are levels where you build your portfolio because, as I said, the whole Fed cycle is premature and it won't sustain beyond a quarter or so. So in that case, the recovery can be quite sharp.
Yeah, absolutely. Makes a lot of sense. And we have to watch this because market still seems to be just sounding too nervous. I mean, even those bond yields and the way gold is reacting. So maybe we'll see a pivot soon enough. Good conversation as always. Short one today on India. Thanks for joining in and have a great day.
Thank you so much.
Okay. Well, that's a view on currencies and commodities and the reason the rupee continues to strengthen, even though the dollar has been rising globally. But back to the equity screen, and the equity screen is looking very, very good. The market, at least it's opened with some momentum, with some excitement. Now it just needs to sustain here and build from here. That's the watch point. 140 points up on the Nifty. It's looking really, really good. Well, it's a good time to bring in our next guest, Seshadri Sen, Head of Research and Strategist, Institutional Equities at MK Global, is with us now. Seshadri, thanks so much for joining in. Good to have you with us on the program today. And we're speaking when the global backdrop has suddenly become so much more benign, a strengthening rupee, falling oil prices, and a war that seems to be finally over. What are your thoughts? Just walk us through, how your portfolios were positioned at the start of the year and whether you made any changes, and how are you thinking about things now that when the backdrop has become, more constructive?
Let me answer your questions. First of all, in terms of the outlook for equities, we remain very positive on the outlook for equities overall. We think that the oil correcting to $70, $70 to $75. We were expecting 75 to 80, so it's undershot our expectations in the short term. Is a big bonanza for the Indian economy and Indian markets. Two issues. One, of course, is its earnings positive. Though to be fair, consensus earnings never took into account the high oil prices. $100 to $110 was never baked into consensus earnings. But now there is more believability in the consensus forecast, which is about 13 to 14% earnings growth on the Nifty, and another, similar sort of momentum across the larger universe. 41% of the top 500 companies are forecast to deliver more than 25% earnings growth in FY27. So these are very strong numbers that the street is baking in. And now that oil is back to $70, it's much more believable. And therefore, we do think that, and on the other hand, valuations had moderated, down to well below 5-year averages. So you will see, all of that playing out, and we see continued positive momentum in Indian equities. So we think in terms of our portfolio, what we around the time that the first ceasefire was announced, oil was still elevated. We put in a few trades, say on the oil marketing company side, commercial vehicles, some UAE exposed companies. We put in some of those into our model portfolio. They've done well. We are not bailing out of those at the moment. We still maintain them, but that was the broad change we made to our portfolio from the beginning of this year. We took the hit when oil prices shot up, but as soon as the ceasefire was announced, we pivoted to a more oil recovery trade.
Correct me if I'm wrong, Seshadri. I went through a note that was, I think, a mid-June note. You folks are expecting a Nifty level of 29,000 by the end of this fiscal. Is that right?
Yes, we are. That is based on long-term average valuations of the Nifty and 15% earnings growth of Nifty in FY27 and similar growth in FY28. So, I think there have been a lot of concerns about whether these estimates can be met. But we are looking ahead now that this oil shock and this energy shock is behind us, and with the possibility that there could be an undershoot and you could get seriously benign energy prices in the foreseeable future. You have to go back to what happened in CY26. There was significant amount of consumption stimuluses that have come stabilized, that have come through from the government. The GST cut obviously was the most prominent. You've seen 125 basis points of interest rate easing. You saw an income tax cut in the FY25 budget. All of that will play out into a strong consumption recovery, going forward. That sort of faltered, but not by much in this quarter because of the energy price worries. And now we think that will come through, and the believability of that recovery is still fairly low on the street. So we do think that there is a strong earnings momentum waiting, and we remain very constructive on the markets. And you're right, we have an aggressive 29,000 target on the Nifty for this financial year.
That's a super duper 20% upside from where we are right now, Seshadri. So then the straight next question, what to buy in this market?
So there are two themes, and I alluded to them in my discussion, that we are very constructive about. Two or three themes. First is obviously discretionary consumption is something that we continue to push very heavily. Within that, we think that the internet space is very exciting. Some of these companies are, at inflection points in terms of growth and profitability. And we think this is a good time to look at the next 2-3 years will be great for these internet companies. Yes, some of them have become slightly well-discovered stories, but there are new stocks coming through via new IPOs all the time. So we keep a significant part of our portfolio there. Apart from that, the entire auto ecosystem we are very constructive about. You can switch between two-wheelers, four-wheelers, and series at the moment looks quite exciting. Tactically, but and there are some very interesting auto ancillary names which are not egregiously expensive. So that entire ecosystem will give you a lot of momentum. The second is on the industrial side. And there again, say for example, I think this is a good time to look at EMS. Some of those stocks have not delivered for some time, and this is a good time to look at EMS. But broader, the power ecosystem is another theme that we like. But power, defense, and real estate in the capital goods side is good to look at. Just be careful of valuations. Some of those at 70, 80 times may have discounted a little too much positivity. So these are the broader things that I think.
Yeah, Seshadri, I was actually just going to ask you that. I'm glad you brought up the valuations point. So for the power sector, where the narrative has been very, very strong, and maybe so have order wins been, where do you still see some rational scope for investment, or is the narrative now running way too ahead of stock prices now within the entire power chain?
See, this is a multi-year positive momentum that the sector will see. All parts, from power generation to power equipment. India as we move up the per capita income curve. India's economy will become more energy intensive, and we need large investments across the chain, from both renewable and thermal generation to transmission to distribution. So it's a large ecosystem. Yes, some of the stocks are expensive, so there's no one particular thing that I can pick at the moment. You've got to go stock wise and pick stocks at reasonable valuations, and there are quite a few out there which are not ATP and still very aggressive.
Okay. You mentioned that you like the internet companies, Seshadri. Now, specifically on the quick commerce plays, there is a big challenger also entering this arena, right? Amazon, and I think they're getting more and more aggressive with their plans. I saw some reports about them looking at a multi-city rollout now in a more meaningful manner. Could that not act as a near-term headwind and maybe restart all the pricing wars, the discounts and all of that?
Yes, it could. In the near term, there could be some headwind when such a large global player is entering the market. It does remain. But we found in multiple internet categories that the late challengers find it very difficult to scale up. And there's a huge difference between doing next day delivery and instant delivery. The entire logistics from ground up, dark stores, etc. It will be challenging, I think, for any new entrant to finally match the scale of the existing players who invested so heavily in dark stores and are continuing to expand their reach. So you will see some short-term noise, but I'm backing the existing players to hold out through this noise and emerge on the other side with their market share largely protected. We've seen that in multiple internet categories where the leaders, hang on to their market share despite competition. It's the nature of the beast as far as internet businesses are concerned.
What about financials, Seshadri? Since you're very optimistic on the index, I'm sure you're looking to add more on the financial side. But the question is what? It's a very wide universe.
Yeah, so our favorite theme within financial, there are two favorite themes within financial. The first is small to mid cap banks. So we saw last year a large amount of strategic investments going into about 6 or 7, some of them were NBFCs, mid-sized lending companies. I think those companies will emerge much stronger, especially now that the worries about the currency and domestic liquidity are abating. You will find that their deposit profile improves. They have more capital and they have more assurance of future capital, so they can grow more confidently. Better systems, better managements will come in some cases, and therefore those are long-term re-rating triggers. It is difficult in the banking space, to find re-rating potential. You may find a book value compounding story, but re-rating potential is difficult to find. But this is one bucket where you could find some re-rating potential. So that is one part of the financial story. The other is a small sub-segment, but we continue to be excited about the capital market segment. And across the space, from wealth managers to asset managers to brokers, yes, there's been some disruptive regulation in the last 6 to 8 months, but all of that will settle down. The long-term story for Indian capital markets remains very constructive. So that's another area that we like. Once again, in some cases, the valuations are a bit stretched, but you also have to understand some of these businesses are massive cash generators. So you're not going to get them cheap anytime soon.
Seshadri, to go back to the overall market question, I mean, what is the earnings recovery that you are penciling in? Because every year we start with this whole expectation of double-digit growth and then it comes down to like miserable single digits. What gives you the confidence that finally it's going to be a different year? And what number might we be realistically looking at?
Yeah, I still maintain that it will be a double-digit, low teens to low double digits kind of, say somewhere between 11 to 14%. Right now, it's running at 14% earnings growth. Will be achievable. There are 2-3 factors. One is just consumer demand remains very strong. The second is that financials last year took a real beating, right? Because at the first phase of the rate cut cycle, they take all the asset yield paid up front, and it's only with a lag that you get a certain, you get some sort of recovery in the margin because your deposits reprice. So there is a margin pop year on year in FY27 over FY26, and I think the street is a little conservative in pricing that, in building that in. Second, asset quality last year was the remnants of some aggressive cleanups of there was some microfinance cleanup, some little pain that went through in calendar 24 on the unsecured lending side. All of that is done. So by and large, I think asset quality, the credit costs will also decline this year. Operating leverage continues to be in play. Credit growth will be very strong. We saw at the fag end of FY26, credit growth go to 16%. It will be, 14 to 15% in FY27 as well. So multiple levers for banks earnings to do well, which is probably one reason why the overall Nifty earnings will find some support.
And from the institutional perspective, Seshadri, so 11 to 14% is good, very good in the Indian context given our struggles. But is it going to be enough to get the foreigners back? Or will we keep seeing more of the same? Because something has to turn, right? Something has to become very meaningful. Either the AI trade has to break for foreigners to go back and look at India, or our earnings growth has to be, offering something sublime. What are you picking up from that perspective when you speak to some of the foreign clients?
Let's start with the AI trade. It's clearly in the bucket of be careful of what you wish for, right? If the AI trade breaks and there's a global crash in AI, Indian equities is not going to do well, and global FPIs are not going to invest in Indian equities at that point in time. There will be a global risk off, and equities as a whole will start to see outflows. So, AI trade melting down is in the short term likely to be more painful for India than beneficial. Yes, India may fall less than some of the markets which were considered AI trade, but that is cold comfort from an absolute investor perspective. Uh, as far as the FPI flow coming back, yes. So there are three worries that FPI have. One is that India is not part of the AI trade, and that is not going to change. India is not going to become, an AI investing destination over time. Two is that the currency was constantly depreciating. That led to a lot of shorting, a lot of exits because nobody liked. So, if we are seeing the currency now stabilize, we think it may go to 93 in the short term because of the oil price correction, and then it will stabilize at those levels. That could attract incrementally a little bit of flows. And thirdly, as we just discussed, this is if I'm right and the earnings come through, this is the first year in three that the India will deliver on earnings. And, apart from all of this, one more problem that India had was that high valuations, no earnings growth. And obviously, that is a deterrent, especially when there are other markets with AI heavy themes that look far more attractive. So, my sense is that the best we can hope for is that the relentless FPI selling will abate. And if you see even small inflows, that is good enough for the market. Remember, the market's held up through massive selling. So if that selling just stops, I think that itself is a big positive for the markets because the domestic flows aren't going anywhere.
Okay. No, I take your point. Yeah, absolutely. In the short term, if the AI trade breaks, then it's going to be a major upheaval across asset classes and fair amount of churn. So, yeah, it would be painful for equities as well. Completely understand that. Seshadri, so let me ask you, what is the one or two, whatever, I mean, the risk factors to your thesis of finally seeing better levels on the Nifty, this 20% rally thesis?
I would say two things. One is, of course, oil is very difficult to forecast. It looks like it's done, but you never know what geopolitical risk. If anybody had told me in October last year that US and Iran get into a full-blown skirmish, it wouldn't have been in anybody's forecast scenario. This is, and that the Strait of Hormuz will be shut for such a long time. So oil remains a key variable. It could be a big positive swing factor. It could also be a big negative swing factor. The second is there is a little bit of worry. I'm not alarmed as yet, but it's something key monitorable is how India's job scenario pans out because otherwise long-term consumption for India will be at risk if the white-collar job scenario. Now, I know there's a lot of alarm about how AI is eating up tech jobs. If you look at the top tech companies, they're shedding people. But one other factor that is in play is that GCCs are continuing to hire quite aggressively. So at the moment, if you look at concurrent data, there is not much to be alarmed about. But if you go ahead, that remains another key monitorable that there shouldn't be a complete implosion of the job scenario because that then flows through to banking asset quality, consumption, and a lot of other factors that remains a risk to our bullish market call.
Okay, Seshadri. Well, hopefully those risks will not play out. Indian investors have been patient for a long time, and they can do with the. That's not your base case, absolutely. And hopefully that we will actually see the upside scenarios play out because it's been a long time that we've been waiting for the animal spirits to come back in the stock market. Thanks very much for joining in. Great conversation. And we wish you a good Thursday and have a great weekend. See you again soon.
Thank you for hosting me. My pleasure.
Thanks very much. So there you have it. That's a bullish view coming in from MK Institutional Equities. They're expecting 20% rally on the index. They have a lot of different sort of themes that they like at this point in time. And they think that 29,000 could happen on the Nifty in the next several months.